So, if you've been watching the markets, you've probably noticed the British pound has been having a bit of a rough time. Well, today we're going to pull back the curtain and look at the main reason why. It all comes down to a huge decision facing the Bank of England. Let's dive in. Right, so what is actually going on with the pound? Why is it losing ground against currencies like the dollar? It's a huge question for investors, for businesses, and honestly for anyone just hoping to go on holiday. And there it is. That's the headline answer, plain and simple. The market is pretty much convinced that the UK central bank is about to make borrowing money cheaper. This one single idea is driving everything we're seeing. Okay, but to really get why this matters so much, we have to understand the basic mechanics. How does a decision made in a boardroom in London affect the actual value of a currency? Well, it all starts with the bank rate. The bank rate is basically the foundation of the UK's whole financial system. It's the master dial that influences everything from your mortgage payments to the interest you earn on your savings. But more than that, it sends a massive signal to the rest of the world. Now, here's a super simple way to think about this. Just imagine you're a big global investor with a ton of cash. You're looking for the best place to park it, right, to get the best return. Well, in a way, different countries become like giant competing savings accounts. And this breaks it down perfectly. When the UK has higher interest rates, it's like its savings account is offering a better deal. That pulls in foreign money. And to invest here, those investors have to buy pounds, which pushes demand up and makes the currency stronger. But when the Bank of England looks like it's about to cut rates, the opposite happens. Those returns suddenly look less appealing. Global capital starts to look for a better deal somewhere else, demand for the pound drops, and its value gets weaker. Okay, so why is everybody so sure a rate cut is on the way? Well, this isn't just a gut feeling. The Bank of England is looking at a whole stream of new economic data that suggests the UK economy is starting to slow down. Let's look at the actual evidence. You see, for months, the UK jobs market was really strong. And that was a big reason for the bank to keep interest rates high to fight off inflation. But the latest reports are starting to tell a very different story. And that changes the entire game. First up, this number right here. 5.2%. That is the new unemployment rate. And get this, it's the highest it has been in 5 years. For the Bank of England, that is a massive flashing sign that the economy is starting to soften. Second, let's talk about wages. Now, when you're a central bank trying to control inflation, rocketing wage growth is a huge worry. But this data shows that that pressure is coming off. Wage growth is slowing down. And if you look just at the private sector, it's at its weakest point in 5 years. This tells the bank that a major fuel for inflation is starting to run out. And of course, the experts are seeing this loud and clear. This quote from Yael Selfin at KPMG really connects the dots for us. All this data, the cooling job market, the slowing pay, it's basically giving the Bank of England a green light to think about cutting rates, and soon. So the economic data is pointing towards a cut. But what about the people who are betting billions on these kinds of decisions? Let's take a look at the financial markets and see what they think is going to happen. You know, in the world of finance, talk is one thing, but where the money goes, that's what really tells you the story. And right now, traders are what we call pricing in a rate cut. That just means they're so sure it's going to happen, they're already making their moves. And wow, this chart from Polymarket tells you everything you need to know. The market is giving it an 86% chance that we'll see a quarter-point rate cut in March. That is an absolutely overwhelming consensus. It's not even a debate anymore about if they'll cut, but more about by how much. And it's not just the traders. A big poll of 63 economists found that a huge majority of them, 41 to be exact, are also expecting a cut in March. So when the betting markets and the academic experts are all pointing in the same direction, investors pay very close attention. Now, it would be way too simple to say this is only about interest rates. The value of a currency is a really complex thing, so to give you the whole story, we've got to acknowledge the other factors that are also in the mix. Yeah, so the big takeaway here is that even though interest rates are playing the main character in the story of the pound right now, they're not the only actor on the stage. Things like the UK's overall economic growth, how risky investors are feeling globally, and even geopolitical events can all push the pound around. But the thing is, with the UK economy struggling for growth at the moment, that interest rate story is just so powerful that it's dominating everything else. And this all leaves us with one last, really fascinating question. You see, a weaker pound makes all the stuff we import more expensive, which isn't great. But it also makes everything the UK sells to the rest of the world cheaper and more competitive. So as the Bank of England gets ready to make its next move, the real question is whether a weaker pound is actually a problem or if it's part of the solution.